Hey, welcome everybody to another edition of Financial Statement Analysis and Valuation. Today we're going to be talking about Module 12, Cost of Capital and Valuation Basics. And you'll remember from your finance prereq that cost of capital has to do with the rate that we're discounting future cash flows back. So fundamentally here we're talking about the time value of money. How much is money worth in the future? And the answer to that question is based on the interest rate or the cost of that capital that we use in the present value calculations. So just a little bit of terminology here. These financial instruments and their underlying value are based on a series of future payoffs. So think of that as future cash flows that are coming from the company. In the case of bonds, those are pretty simple. Those are interest rates and principal payments. In the case of equities, that's a little bit more challenging. Those can be dividends. Those can be cash flows paid to equity holders, so cash that the company retains that would flow through to retained earnings. And we have valuation models that are based on each of those cash flows. And we've shared a few of those, but we're going to go in a little bit more detail here in Module 12. Let's talk a little bit about the terminology here. Generally, when we talk about cost of capital, I want to focus in on these red bullet points here. Cost of capital refers to the discount rate that an investor uses to value future payoffs. So that's the rate that we're going to use in our present value formula. And that's easy when we're trying to value a bond, right? Because earlier in the semester we talked about the coupon rate and the market rate of interest. And those are given, or at least that we can infer those, or we can look those up based on where a bond is trading. For equities, it's a lot more challenging because that rate is going to reflect, in the second bullet point here, we can see that rate's going to reflect the return that investors expect on their investment. And it's also going to be based on the perceived risk of an investment. And this is where the challenging part comes in, because perceived risk can be fairly subjective. Everybody in our class could potentially have a different perceived risk associated with an investment. And that's a big part of the semester-long research project that's associated with this class, is digging deep on the competitive positioning and analysis and management team and financial statement analysis and ratios and so on and so forth, so that you have an understanding of what that risk really is. And through all of your efforts, you should be able to come up with a more informed perception, I guess, or more informed decision about what that risk level is. And then that risk level is going to help us determine the real cost of capital. And we'll use that real cost of capital to discount those future cash flows. And if we know both of those things with certainty, if we know what the risk level is and the cost of capital is, and we've been accurate in the future projections of our cash flows, then we also know with certainty exactly what a company's worth. Now, we can never know those things with certainty, but we put a little work into it, and the hope is that we can, on average, be better analysts, better forecasters, and better at our job than some others, many others, who are subject to the emotional ebbs and flows of the stock market, and that the practice of that discipline over time will yield real value to us in the analysis of these companies, and then also to portfolio managers who build portfolios of stocks and bonds on behalf of clients that include pension funds and insurance companies and individual investors and so on and so forth. So just kind of some high level, big picture vision casting, I guess, there for what we're really trying to do, which is, in this module, identify the cost of capital and the components that go into it, and then forecast those future payoffs. And then next week we'll look at some individual models for discounting those future payoffs. Learning and objective number 1. Explain the basics of valuation, include intrinsic value, discounting, and payoffs. I mentioned each of those, but let's talk in a little bit more detail here. when we're identifying cash flows, it's important to know what we're talking about and where the cash flows come from. I mentioned with a bond, that's easy. We have the receipt of interest payments and we have the receipt of principal payments when the bond matures. And we looked at that in detail in an earlier module. With stocks, it's a little bit more challenging. We can follow the cash just like anything else, and when we follow the cash, those are dividends. But net income is usually covers dividends, and then it usually covers some reinvestment back into the firm, and that reinvestment serves as a growth engine for future cash flows. So those are of real value to an equity holder, and we can look at those, which would be the cash from selling stock to another investor or back to the company. Nope, wait a minute, I got a little bit ahead of myself there, I apologize. If you just look at the holdings of an individual stock, say you own some IBM or Coca-Cola or Ford stock, well, you have an outlay of cash when you buy it, you'll collect dividends between time A and time B, and then you get the cash from selling that. I guess that would be at time B when you sell the stock, and that's going to be called what we're going to refer to as the dividend discount model when we use that valuation. And when I say I got a little bit ahead of myself there, theoretically we can also use a discounted cash flow valuation, which will be next module, I think 14, and that looks at the underlying cash flows to the business as if we were to hold that into perpetuity. So it's a slightly different frame of reference, but we'll walk through both here. To do this right, we're basically going all the way back to the beginning of our semester. Forecasting cash flows is not easy, and to do it right, we have to have a very good understanding of the economics that drive this business and the motivations of the management team and some insights on their long-term perspective and how they're going to go about executing all that. And that's where we started the semester. And you might recall that we looked at this chart. The authors break that process down in 4 steps, and we've chunked it out with various modules this semester. The first step is to understand the business environment and the accounting information. So we're going all the way back to Porter's 5 forces and a basic SWOT analysis. Step 2, adjust and assess financial and accounting information. So after we've assimilated all of this accounting, we need to be able to create pro formas so we can accurately compare where this company is today, where it's been in the past, where it's likely to go in the future against its peers and other competitive forces that are going to have an effect on those financials. And those adjustments give us better insights into the true and underlying economic reality of what's going on. Step number 3, based on all that information, we're going to forecast those financials into the future. And this is where I say we can never get this perfect, but with all the work we've done this semester, we ought to be better informed than a lot of other investors, and the disciplined practice of that skill set should pay off for us on average over time. Lastly, we're going to take those forecasted financials, we're going to use our cost of capital, we're going to discount those cash flows back to the present value and calculate what the firm is actually worth. Our authors unpack each of those steps here in the next few slides. Step number 1, understand the business environment and accounting information. Again, we're assessing profitability, quality of earnings, growth opportunities, competitive and macro threats. I mentioned specifically SWOT analysis, Porter's 5 forces. That should all sound familiar. Step number 2 was to adjust and assess the financial and accounting information. So we need to adjust that in a way that helps us predict the payoffs from the company. So this is obviously a crucial step and gives us the key inputs into our valuation models that we're going to be looking at here. Step 3, forecast that information in the future. So we're taking our financial statements, and we've talked several times about forecasting the income statement, forecasting the balance sheet, forecasting the statement of cash flows, and making sure that those statements articulate, meaning that the income statement flows to the balance sheet and the balance sheet balances, and together they help to reconcile the cash account on the statement of cash flows. And that's what we mean when we say that those statements should articulate. And if all that holds and we're consistent with competitive expectations and managerial forecasts to the extent that we agree with them, then we probably have a good estimation of what's going to happen in the future. We can adjust that for the level of risk inside the company, and that's when we move on to step 4, which is the actual valuation. We're going to select from amongst several valuation frameworks, and one might be more appropriate than another given the nature of our business. Banking institutions lend themselves pretty well to ratio analysis. Price to book in particular has worked well. Manufacturing companies can be rather cyclical in their nature, so we have to factor that in. Tech companies can have extremely high growth rates, and those don't always lend themselves to a long-term forecast that would be conducive to a discounted cash flow model. So we have to balance the model that we pick with the level of accuracy and precision and confidence that we have in the forecast of those future cash flows. Okay, let's look at the basic equation for calculating intrinsic value. In this first bullet point here, our authors define the theory. Theoretically, the economic value of a company assumes that the future actual payoffs are known. And the future actual payoffs here is how much money the company's going to make in the future. That's what we call cash flows. How profitable are they going to be? How much of that cash is going to flow to the bottom line? How much of that bottom line is going to be distributed to shareholders? If we know all that with certainty, then theory says we know what the company's worth. So the best hope we ever have is to be directionally correct in finance. And all this information should inform our decision making, but I think you as analysts should recognize right off that that first bullet point is always going to be a little bit lacking. So the basic formula that you can see in the middle of the slide, IV stands for intrinsic value. The intrinsic value of the firm equals the intrinsic value of the debt. Not too difficult to figure out what the intrinsic value of the debt is. It's publicly stated. Plus the intrinsic value of the equity. That's where all of the challenge comes in. What's this equity worth? And to know that, you got to go right back up to that first bullet point. We got to know what's going to happen in the future. And unfortunately, none of us have crystal balls. So this is something of an art and a science both. And as you do more of these, for many of you in this class, this research project is probably the first one that you've done of this size for sure. As you do more of these, you develop a real skill set for being able to forecast cash flows into the future and understand what drives companies and become something of a student of the underlying financials and economics, and you get good at this. You get really good at this, and there's a lot of very high-paying jobs on Wall Street and for other portfolio management companies that are in high demand. And if you have an interest in this, then absolutely I would encourage you to pursue it and connect with me, because I would love to help you pursue that goal. Okay, these next few slides are a review of the time value of money. We've been talking about forecasting future finances and cash flows. Those are major inputs into any calculation of intrinsic value. Once we have those inputs, we have to be able to discount those cash flows back to time zero, and that's basic time value of money equations. This should be review from your Finance 101 prereq, and I'll spend just a couple of minutes walking you through that, but not much because this is review. Steps number 1, forecast the payoffs. Payoffs just mean future cash flows. Determine the discount rate. That's a little bit more challenging. Here's our formula. The present value factor applied to a future cash flow, so we're going to say one that's next year, is 1 over 1 plus r to the n. R is the discount rate, n is the time period, so usually measured in number of years. Here's an example. So the present value of $100 times the present value factor of 0.811, which is reflective of a 2-year time period and an 11% discount rate. You can find that in the table. It's just as easy to use an Excel calculator or a financial calculator to type this in. Either way, we're back to this basic formula, which is 1 over 1 plus r. R here is 11%, raised to the nth power. N represents the number of periods, so that would be 2. So if you type in 1 divided by 1.11 raised to the power of 2, that's going to produce the same result as 100 times the present value factor of 0.81162. You can use it in Excel, or you can use a financial calculator. You're going to get 90.09 as a result, regardless of which method you use. That's the present value of a series of cash payments. Not a series, just one cash payment 2 years from now, discounted at 11%. Annuities would be the series of cash payments. So in an annuity, you have to identify the series, and they have to be equal amounts. So you got 2 or 3 years of cash flow at the same amount. Payments must occur at equal time periods, and the same discount rate is applied over the time horizon. Here's our formula for an annuity. Basically the same thing. We type all these numbers into an Excel spreadsheet. We've got 4 time periods, got the same interest rate in each time period. The present value is 1 divided by 1.11 is the discount rate, raised to the power of 1, 2, 3, 4, corresponds with years 1, 2, 3, 4. Present value factor, we can look this up in a table or we can calculate it ourselves. Series of payoffs is $1,000 in each year. Each of those payoffs discount back to a present value, add all those present values up, and you see here that the present value of this 4-year annuity at a discount rate of 11% is $3,100. Now, rarely do you see in the real world a series of cash flow payments like that associated with a company, because that would imply that they're generating the exact same amount of cash every year. But it might be a better assumption than wildly forecasting variable cash flows in future periods when we don't have anything better to go off of. And I'll show you how that works here in a minute. And it can be especially useful when we're trying to zero in on or triangulate a range of valuations that we think is reasonable, because again, none of us have a crystal ball here. We're trying to predict the future. So usually the way this works is, as an analyst, we'll use several valuation techniques, and then we'll weight them according to which ones we believe to be, I guess, a better fit or best fit. And then based on a weighted average of those valuations, we'll zero in on kind of a range of reasonableness or even an individual price target. This next slide is a proof statement, basically. If we know these cash flows, we can lay them out in a spreadsheet across the columns, which correspond to the current time period, years 1, years 2, years 3, years 4. We know what the interest is going to be in each of those time periods because we're using an 11% discount rate. We know what the future value would be at the end of that period, because if we have $3,100 today and we earn an 11% interest rate, then at the end of 1 year, we're going to have $3,400. And if we have $3,400 in a year and that earns 11% interest, then at the end of year 2, we're going to have $3,800, and so on and so forth. And the authors are proving out here that we are indifferent, or an investor rather would be indifferent, between $4,700 in 4 years, $3,100 today, or a series of $1,000 in each of the next 4 years. If we have an 11% interest rate, those 3 options are identical. Okay, let's move on, talk a little bit about bonds. This is review. You'll recall from a prior module that we have coupon rate, face value, and market rate associated with all of our bonds. This is how we use them to get back at intrinsic value. You'll recall that the coupon rate determines the annuity payments. We're going to take the principal value of the bond as printed on the face of the bond times the coupon rate, and those are going to be our annuity payments. The face value of the bond stipulates the lump sum payment to be made at the bond's maturity. So that's the $1,000 increment. Typically, bonds are issued in $1,000 increments. So most of the time, the face value is going to be $1,000. The coupon rate is on the face of the bond too. So let's say that's 6%. Then the annuity becomes 6% times $1,000, or $60. And that's usually issued, you'll recall, in semi-annual payments. So that would be payments of $30 twice a year for the term of the bond. The market rate is the interest rate an investor could earn by investing in other bonds with similar risks. Now, you'll recall that the market rate fluctuates That's the rate that we want when we're determining our cost of capital to discount these cash flows. So, review again, let's value a debt instrument. Okay, so let's walk through how we would do this in practice. We're looking at a debt instrument here. This is a 3-year bond with a 9% coupon rate, a face value of $1,000, and a market rate of 10%. So we have our 3 inputs. Let's lay those cash flows out in a spreadsheet here. We know we're going to receive a $90 interest payment at the end of period 1. That's just the 9% coupon rate times the $1,000 face value. And that'll continue for period 2 and period 3. And then at the end of the bond, we're going to get our principal back. That's our $1,000 cash flow payment in year 3. Now let's discount those cash flows back using our discount rate, which is the market rate of 10%. The present value of the lump sum at the end of 3 years is that $1,000 times our present value factor of 0.75. That gets to be $751. The present value of the annuity, which is the $90 payment over the period of 3 years, amounts to $223. The present value of all those cash flows sums to $975, and that's the value of the bond, or the amount that the investor would be willing to pay in exchange for those cash flows. Okay, now let's segue and imagine an equity instrument, so a stock, with the exact same series of cash flows. So in this example, we have a stock that's paying us a $90 dividend at the end of each year, so the same as the interest we're receiving from the bond. We hold that for 2 years, along with a terminal dividend of $1,090 at the end of 3 years. So that would be like the sale of the stock, right? So we hold a stock, we get a $90 dividend in year 1, we get a $90 dividend in year 2, we get a $90 dividend in year 3, and then we sell the stock for $1,000. So just call this, I don't know, 10 shares of GE or something like that. We can value those cash flows the exact same way that we just valued the cash flows with the bond. Let's take the present value of the lump sum payment, meaning the sale 3 years from now, discount that back at 10%, equals 751. Then let's use our present value of the annuity formula to value the series of dividends in this case. 3 dividends discounted back at 10% amounts to $223. Sum the present value of those cash flow payments, and we see that this stock with that series of cash flows is worth the exact same amount as the bond, $975.13. Okay, next we're going to go into discount rates and how they apply to stocks and bonds. We're going to differentiate between the cost of debt capital and the cost of equity capital. The cost of debt capital is the number that we'll use for bonds. In that last example, we used a 10% discount rate for both. And that was an oversimplification, because if we have a 10% discount rate for bonds, equity investors are always going to require a higher rate of return, and therefore we need to use a higher discount rate for the cash flows associated with equity than we do for the cash flows associated with bonds. Now, why is that? Well, it has to do with capital structure. Equity is inherently more risky than bonds because in a worst case scenario, the bondholders are going to get paid back first. And oftentimes there's collateral associated with the bonds that makes it much safer to own those investments than it would be just to own the stock of a company outright. We take on a lot more risk. We need to be compensated for that risk, so our discount rate needs to be higher. So let's look at the factors that go into each of those, meaning the cost of debt and the cost of equity. And then let's look at what we call a weighted average cost of capital based on the underlying capital structure of the firm. This next slide is not as clear as it could be, but this is a complicated topic, so I'll try to break it down in as simple terms as possible. What we're really talking about here when we talk about cost of capital is how much risk we're taking on, and that is comparative in nature, meaning that the cost of capital for one investment is always going to be comparable to the universe of other investments. So let's start with something that we call the risk-free rate. If we're going to take our money and we're going to put it at risk, there's an opportunity cost there. And the opportunity cost is we could have put it in the bank in a T-bill or a FDIC federally guaranteed CD that's going to pay us X percent. And for the sake of argument, let's just say that we could get 2% if we put it in the bank. Now that's guaranteed by the full faith and credit of the United States government. So we're going to call that the risk-free rate. Well, if we can get 2% without any risk whatsoever, then we better be able to get more than 2% if we're going to take on the added risk of a stock or a bond. And that conversation is broken down by the authors of our text in two components. First is the time value of money. That's the risk-free rate, the foregone interest from investing in an instrument with future payoffs. And then secondly, it's the cost of risk. So risk-free rate plus the cost of risk, which is the amount due and payable back to the investor for being willing to take on added risk with their money. Now that second component, the cost of risk, you'll oftentimes hear referred to as the risk premium. So remember that term, the risk premium. Okay, let's take it a step further. And I want you to be familiar with something called diversifiable risk. This refers to the risk that can be diversified away by investors. And I want you to contrast this to non-diversifiable risk, which would be the risk associated with the market. So stock prices in general, stock price increases cancel out stock price decreases, reducing large price movements. So that this slide's a little confusing too. I want to see if I can break this down in clearer terms, because what we're basically talking about here is that we can take one individual stock that might have a very high degree of business-specific risk associated with a sales strategy or a drug pipeline or M&A activity or any of the other components that are risky and specific to the individual company that you've been analyzing throughout the course of this semester. Those risks, which we call idiosyncratic, can be diversified away by constructing a portfolio with hundreds of different stocks, because when one company benefits from merger and acquisition activity, another company might I guess suffer from M&A activity, and those idiosyncratic risks have a way of balancing each other out, and we call those risks diversifiable. And it's important that you be familiar with that term as we move into cost of capital calculations associated with what we'll talk about here in a minute, which is something called CAPM. Okay, so let's move on to our next learning objective, which is to explain and estimate the cost of equity capital. And we'll talk about that CAPM. CAPM is what's commonly referred to as the Capital Asset Pricing Model, or CAPM for short. And that is going to allow us to calculate the expected return on particular assets, and it breaks down like this. We're going to start with the risk-free rate, which is that time value of money component to the discount rate that we reviewed and talked about. And then we're going to calculate our risk premium. So there's a risk-free rate, which is the time value of money, and then there's a risk premium, which is associated with how much risk we're taking on associated with a specific stock. And as I just mentioned, a component of that risk is stock-specific risk. We're going to also refer to this as diversifiable risk. So in component form, you see CAPM, which is denoted here RE, that's the risk associated with a particular equity or the risk of a stock. So this is would be our equity discount rate is what we're calculating here, equals the risk-free rate, that's the time value of money component, or the amount we could earn if we just put our money in a guaranteed CD or risk-free T-bill. And onto that, we're going to add this component right here, which is called the risk premium. If you just underline this component, you can think of that as the risk premium. And the calculation is beta risk. Beta risk is the extent to which a stock fluctuates with the underlying market, usually measured by the S&P, plus or times the risk to the market minus the risk-free rate. And we can look at an example of that here. But before we do, I want to dive into this terminology a little bit so that we all have a common understanding of what we're looking at here. The risk-free rate, that's commonly based on the 10-year U.S. Treasury bill. It's important that the risk-free rate match the duration of the bond or equity that we're looking at. So with bonds, that's a little easier. The risk-free rate will match the term of the bond. With equities, usually our holding period is long-term, so the rate on the 10-year U.S. Treasury would be appropriate. But if we have a shorter-term holding period, then maybe we want to use a shorter-term risk-free estimate. The market risk premium, that's the difference between the expected market return and the expected risk-free rate. And I just want to draw your attention to that word expected there. That's what creates a particular challenge for us as analysts, because again, we're trying to predict the future, so we need to have an understanding of what the risk is associated with a stock investment, and that's going to be relative to the future market return and the future interest rates. So not only do we have to have a good understanding of what we expect the future cash flows to be associated with this stock, we also have to have a good understanding of what we expect the future market return and the future risk-free rate to be, so that we can contextualize that, because every investment is an exercise in opportunity cost, and understand the trade-offs that we face. Now that's incredibly challenging, and if you look back at the history of market professionals that have tried to do this, they don't have a great track record of it. So what you see in practice a lot of times are professionals using the long run average return to stock markets and the long run average return to bond markets in lieu of an expectation of future returns. It's a measure that has proven to be as accurate as anything else. So if we say that the long run average return on the stock market has been about 9%, we could use that as an expectation of what it's likely to be over the next 10 years. If we say that the long run average return to the U.S. Treasury bill has been around 5%, we can use that as an expectation of what it's likely to be over the next 10 years. Now, we can get more granular with it because the 10-year Treasury today is less than that, so it would be just as accurate to use a lower rate today. I'd probably say more accurate. And then the expected market rate of return, well, it ought to fluctuate with the business cycle somewhat, and we're currently well into a bull market, so we might take the long run average expectation, which is about 9%, and lower it a little bit. So if we used 8% for equities and say 3% for bonds, that'd probably be a pretty good measure of where we're at in the current market cycle. And then lastly, market beta. Beta is a sensitivity of an asset's market return to the overall market. So this should reflect historical stock price volatility. And you can look this up on Morningstar or Yahoo Finance or any one of a multitude of different sources, and you're going to see a beta number that varies between -1 and 1. And that is an indication to what degree a stock market's volatility is consistent with the overall volatility of the stock market. We don't always have a good estimate of beta. So for example, if a company has just IPO'd, we can't look back historically and get a good estimate of that volatility in relationship to the market. So sometimes we have to make certain assumptions. That's one of the reasons why when I suggest the list of companies that you're able to choose from to do your semester research projects, I look for companies with significant histories that give us an opportunity not just to analyze the financials, but then also to calculate things like beta, so that our estimates of CAPM can be a little bit more meaningful. I mentioned beta will fluctuate between -1 and 1. Here's how you read that. If a stock has a beta of 0, there's no relationship between its historical trading patterns and those of the stock market as a whole. And usually this is measured relative to the S&P 500, like I mentioned. So if we use the S&P 500 as a representative of the market and a stock has a beta of 0, we can't really use that number to inform us as investors about what its likely future return expectations are going to be relative to the market. Okay, let's contrast that to a stock who has a beta of 1. A beta of 1 tells us that if we look at prior trading activity, that stock has moved very similarly to the underlying market. And our expectation would be that if next year the market was up 10%, this stock would also be up 10%. Let's take a stock that has a beta of 1.1. That means that its volatility is 1.1 times as great as the market's. So if the expectation that the stock market was going to be up 10% next year, then the expectation of stock with a beta of 1.1 would be that it would go up 11% in the next year. And you can see how that relationship holds as a beta moves from -1 to 1 and sometimes beyond. Pulling it all together, here's our example. Midwest Corp has a market risk premium of 4.6%. Remember, 4.6% was that second term, which was the return on the market minus the risk-free rate. And a market beta of 0.56. The 10-year treasury is 5.2%. How much is CAPM? So here's our basic CAPM formula. Let's plug in all the constituent pieces. The required return on equity, or the discount rate for equity here, equals the risk-free rate of 0.052 plus the expected return on the plus beta of 0.56 times our market risk premium of 0.046 equals 7.8%. That's our discount rate for Midwest Corp stock. We're going to use that as a major input into our weighted average cost of capital, and as you'll see moving forward, ultimately our discounted cash flow analysis. Okay, moving on to multi-factor models. And I always get a kick out of this slide because the authors give us one slide on something that could be a whole semester class, but it's interesting conversation. The CAPM assumes that the risk associated with an individual stock is relative to how closely its volatility mirrors the historical volatility of the stock market. That's what beta is. That's the beta component, and that's okay. That has worked very, very well in many aspects. But multi-factor models assume that a stock's underlying risk is associated with beta as it applies to the stock market, but then also its relationship to other factors. And that's what we mean when we say multi-factor models. CAPM is a single factor model. Multi-factor models have more than just one beta. And these betas are relationships to other underlying factors, which might be things like GDP or unemployment or prior growth rates. And there are some very, very sharp mathematicians and statistics and computer programmers from MIT and Caltech that spend the majority of their time analyzing these historical patterns and programming big computers that specialize in machine learning to take advantage of these trends and eke out small returns over time in the stock market. And some of them have done this very, very well over time. So just be aware of what multi-factor models are and how these equations would come together. The return on equity component is the same. You can see here from the calculation, the R of E, which would be the discount rate associated with equity, equals excuse me, equals your risk-free rate plus the risk premium. The risk premium now is just based on many factors instead of one. Okay, let's move on to learning objective number 3, describe and estimate the cost of debt capital. This should be a little bit more straightforward because we have the interest rate, we have the coupon rate, we have the market rate, we have the face value. These things are what we need to determine a company's cost of debt. So we can look at some of the factors that ought to have an influence on those. This should all be review. The factors are liquidity measures, financial stability. You'll recall in a prior modules we looked at credit ratings by Moody's, S&P, Fitch. We also looked at the ratios associated with each one of these ratings, and we saw how those ratios, and especially the interest rates associated with different credit ratings, falls off significantly when a company moves from investment grade to higher yield categories. That analysis is pretty straightforward. What adds a wrinkle and complicates things just a bit is that as an equity holder especially, we're going to be concerned with the after-tax cost of debt, because remember, debt produces an interest tax shield. Any interest expense that we pay on debt is a direct deduction from our net income, and therefore we don't have to pay taxes on that amount. It's like the home mortgage deduction. You pay 5%, but you get to deduct it from your tax rate, so the after-tax cost of owning a home is something less than 5%. Well, it's similar with debt. That's a good example for what we're trying to get at here, because it affects the economics of a business. There's advantages to taking on debt, and one of those advantages is that the interest rate is tax deductible. So we're going to look at that, and we're going to divide it into two components. The cost of debt, which, just like we computed a cost of equity, this is going to be the discount rate that we use for our debt, is the pre-tax borrowing rate, determined by those things we just looked at: liquidity, financial stability, underlying credit rating, so on and so forth. Going to be that pre-tax borrowing rate times 1 minus the tax rate. And we looked at the tax rate in a previous module. You'll be able to find that in the back of your 10K filing, broken out in a tax schedule that gives you a lot of detail into what the true marginal rate is for your individual company. Let's look at an example. Midwest Corp here again has a marginal tax rate of 34.6%. Interest expense for 2014 totaled $648,000, and the average debt was $8 million. How much of its after-tax cost of debt capital? How much is its after-tax cost of debt capital? Well, we know our components. That's going to be set equal to RD is our after-tax cost of debt capital. That's going to equal the average borrowing rate times 1 minus the marginal tax rate. We know all those. Let's plug them into our calculation. We know we paid $648,000 in interest. We can get that directly from the income statement. If you're looking for that number regarding the research project that we're doing this semester, just check the income statement. Probably be disclosed right there. We know the debt outstanding on average was $8 million. And we're going to take that divisor, I guess, and we're going to multiply that times 1 minus the after-tax rate, which was given at 34.6%. You can also find that in the back of your 10K filing. And that formula produces an after-tax cost of debt of 5.3%. Next, let's put it all together. We know our cost of equity, we know our cost of debt. Let's explain and estimate the weighted average cost of capital. Well, I'm hopeful that'll be pretty self-explanatory from the name. The cost of capital includes an equity component, it includes a debt component. The weighted average of those two things is going to be the weighted average cost of capital. Now, how do we compute a weighted average? Well, we're going to look at the capital structure of our firm, and we're going to figure out how much of the total capital structure is comprised of debt, how much of the total capital structure is comprised of equity, and we're going to multiply those fractions times the cost of each to get a weighted average. And let's look at that. That basic equation is laid out right in the center of slide number 36 here, where R of W is our weighted average cost of capital. And that's going to be set equal to R of D, which is our cost of debt, times basically the percent of the total firm that's comprised of debt. So you take the intrinsic value of our debt, which you can get from the balance sheet, divided by the intrinsic value of the firm. plus the cost of equity, which is the intrinsic value of the equity, which you can get from the balance sheet, divided by the intrinsic value of the firm. Now we can get those numbers from the balance sheet, or we can get them from the market value. So if we get them from the market, and that's what would be typical, we're going to use the quoted market price for equity. And here's our example of Midwest Corp again. We already calculated that it had a 5.3% cost of debt and a 7.8% cost of equity. Now we know that the market value in thousands of its debt is $2.5 billion and the equity is $4.3 billion. We can look that up, Morningstar, Yahoo Finance. How much is the weighted average cost of capital? Well, the intrinsic value of the firm equals the market value of the debt, which is $2.5 billion, plus the market value of the equity, which is $4.3 billion. That comes to $6.9 billion. So we're going to plug all those numbers into our formula. We're going to compute the weighted average cost of capital here denoted as RW equals 0.53, which is the cost of debt, times the percentage of the intrinsic value of the firm that's debt, plus the equity side of the equation. And the weighted average cost of debt calculates to 6.9%. And I love this graphic because I think visually, I think a lot of us think visually, but I don't find it that useful. I guess you have the firm equals the debt plus the equity, simple enough. And then the debt plus the equity, you got little green lines coming back to the firm here, and little orange lines coming back to debt and equity as sources of risk. I'm hopeful for that's useful for some of you in class, but I don't have a great explanation for it. So let's just move on. Let's talk a little bit about a weighted average cost of capital with preferred stock. Some of you are going to be looking at companies that have preferred stock. If you do, then the first thing that you need to assess is the materiality. If your preferred stock is not a significant component of the capital structure, then you can probably just set it aside. But if it is a significant component of the capital structure, then remember, preferred stock is something of a hybrid investment vehicle. It has aspects of the investment that look like a bond, and it has aspects that might function a little bit more like an equity. Accordingly, it's going to have its own cost of capital, and it'll have its own proportional makeup of a firm's underlying intrinsic value. And if so, then you would use a formula that looks something like this. We're going to take the weighted average cost of capital here denoted by RW equals the two terms we already looked at. RD is the cost of debt, RCE is the cost of common equity, RPE is the cost of preferred equity. And usually preferred equity has a face value interest rate associated with it, much like a bond. So it'll be 8% times the capital structure, the percentage of the capital structure. So not terribly complicated. Just wanted for you all to be aware of that and how it works. I think you can probably work your way through a formula like this. And if you need a little help with that, just reach out to me. I'm glad to sit down with you and spend some time talking in more detail. Okay, let's move on to the dividend discount model. This is the simplest equity valuation model. And we looked at this at the top of the lecture. It equates the value of a company, the value of a company's equity, with the present value of all future dividends. And then we're going to view those dividends as similar to interest rate payments on a bond. And then at the end of our time period, we know that we're going to have an additional cash flow stream, which is the sale of that stock. And that, the layout of those cash flows is something that we call the recursive process of valuation. So we're going to take the intrinsic value of the equity at the beginning of period 1, and we're going to set that equal to the dividends to be paid during period 1. And this could be multiple periods here, but we're oversimplifying again. And then we're going to add to that the value of the equity at the end of the period. So in this example, we just have one period, so very simple. And then we're going to discount that back one period at the cost of equity. And you can see here that that's laid out with the terms at the bottom of slide 41. Let's walk through an example, and hopefully that'll be a little bit more clear. Midwest Corp, again, in this example, has an expected dividend for period 1 of $1.50, and its expected intrinsic value of equity at the end of period 1 is $32. That's the more challenging piece, is to come up with that expected intrinsic value, but let's deal with that next. The cost of equity capital for similar firms is 7.6%. What is the intrinsic value today? So we're going to use our intrinsic value formula here. We're going to plug all our numbers in. The intrinsic value equals $1.50 dividend plus $32, which is what we expect the stock to be worth next year, divided by 1 plus the discount rate, which is the cost of equity. So that's 1 plus 7.6%. And we have just calculated that the present value of that stock is $31.13 today. And that's using the dividend discount model. Now, let's remove that simplification and recognize that dividends typically occur in a series of payments, and we typically hold a stock for longer than 1 year. Well, when that happens, we have something that looks more like this. We have the intrinsic value equals the dividends in periods 1, period 2, period 3, each discounted back. And if we hold that stock forever, these will just keep on going, and we call that the perpetuity method or the constant growth method. And if we know that we're going to have a series of cash flows that go into perpetuity, well, that's a very convenient assumption because we have a formula for discounting that back. And let's look at that in learning objective number 5, which is to describe and apply the dividend discount model with a constant perpetuity. Okay, so here's our formula. When we have discounts, when we have dividends that we expect into perpetuity, so that let's just use that $1.50 that we did in the last example, we're going to set that equation equal to the dividends in periods 1, period 2, period 3, all the way up to period N, which is kind of into perpetuity here, or maybe we go out 5-6 years, plus the dividend in period N plus 1 divided by the required return on equity, all divided by 1 plus r to the n period. Okay, a little bit complicated, I know. I'm hopeful that we can simplify that by walking through a real-world example. And in this example here, we have Midwest Corp has an expected dividend for 2 years at $1.50, followed by 2 1/4 in year 3, and $2.75 per year thereafter. And what we mean by thereafter is forever, into perpetuity. We know our cost of equity capital is 7.6%, so we can plug those numbers into that equation that we saw on slide 45 there, and this is what we get. We get the dividend in period 1, which is $1.50, and we're going to discount that back 1 period. In period 2, it's $1.50 again, and we're going to discount that back 2 periods. In period 3, our dividend rises to 2 1/4, and we're going to discount that back to year 3 periods. Now we have period which is N plus 1. So this is our perpetuity dividend. And now we have 2 1/4, which is what we expect into the future forever. And we're going to divide that by our discount rate, and that's going to be our numerator. And then in our denominator, we're going to take that 1 plus our discount rate and discount that back by 3 periods. When we set all that equal to our intrinsic value, we plug in those cash flows and we come up with a stock price of $33.55. Okay, next, explain and apply the dividend discount model with an increasing perpetuity. So this adds a little wrinkle to it. Very rarely, if ever, do you have a dividend that stays the same forever. In that last example, the dividend of $2.75, the assumption was it never changed. Well, typically you'll see a dividend increase at least with like GDP growth as inflation goes up. So how would we factor that in? And that would look something like this, and it's what we refer to as the Gordon growth model. So this is a dividend discount model, but slightly different version. And in this version, we call it the Gordon growth model. So we have the same basic formula, same basic architecture here. We got the dividends in the early periods, plus the dividend in whatever our forecast period is. If we think that we have insights over the course of the next 2 to 3 to 5 to even 10 years about how that discount is going to grow. Maybe there's a period of time where we expect those dividends. Excuse me, I said discount. I meant to say dividends. Maybe we have insights into those dividends growing at a rapid pace for the next few years, but we don't have any insights into what they're likely to do beyond our forecast period of, say, 5 or 10 years. In which case, it would be more reasonable to just assume they grow with GDP. And if that's our assumption, then our formula would look something like this, which is the Gordon growth model. And the only difference is in this final term. We're going to take our dividend and we're going to multiply it times 1 plus the growth rate, whatever we expect the growth rate to be. If that's GDP, fine. And then we're going to divide by our cost of equity less that same growth rate. So let's see what an example of this would look like. Midwest Corp again, same dividend for the first 2 years of $1.50, followed by $2.25, and then in year 3 it goes to $2.75, and then in year 4 it holds at $2.75 with a 2% growth rate thereafter. So into perpetuity for every year after that, times 2%. Here's how that would work. We have our same dividends in the first 3 years, $1.50, $1.50, $2.25, all discounted back by 1 plus the required return on equity to the number of years, plus 275 divided by the cost of equity less the growth rate. That's our numerator. And then our denominator is going to be the 1.76 cost of equity, all discounted back 3 years. Simple enough. That produces a present value of 43.92. And you can see there, the only real difference between those two formulas was the growth rate. And the present value went from, what was it in the last one? It was 33.55 to now 43.92. So pretty good difference in present value. Almost $10 just by increasing the growth rate 2%. And then lastly, on slide 50 here, our authors just note some challenges we need to be aware of. A large percentage of companies don't pay dividends, so this analysis is not going to lend itself very well if companies don't pay dividends. Some companies have unusually high dividend payout ratios that may not be sustainable, so they need to be mindful of that. Those can create challenges, and we're alluding to the need for other valuation methodologies, which we will cover in modules 13, 14, and 15. But for now, that's going to wrap us up. So that was module 12, and I look forward to seeing you in class.